Hi everybody. Most investors doesn't lose money because they picked a bad industry. They lose money because they trusted the wrong numbers. And when that happens, the stock doesn't fall gently, it collapses. So this video is not about finding multibagger, it's about avoiding landmines. Let's start this video with a case study. Satyam Computer Services was started by Mr. Ramalinga Raju in 1987. It provided services including software development, consultation and IT. Company focused on high-end services and had top-tier management. It went on aggressive expansion and early adoption of international quality standards. Over the 5-year period from FY 2003 to FY 2008, Satyam's revenue grew by 31% CAGR and net profit grew by 35% CAGR. By 2008, Satyam became India's 4th largest IT firm. On 16th December 2008, Satyam announced a plan to acquire 51% stake in Maytas Infrastructure and 100% stake in Maytas Properties, both together valued at $1.6 billion. Both these companies were promoted by Satyam's chairman's son. But shortly after the announcement, the shares of Satyam fell by 55% in New York Stock Exchange, as this business was also listed there, in a single trading session. Also, investors and institutional funds criticized the deal and finally the deal was called off. Then, on 7th Jan 2009, chairman of Satyam resigned and admitted a fraud of manipulating company's financial statement. As the news came out, the Satyam stock fell by 78% in a single day in Indian stock market. Surely, many investors would have seen a sudden erosion in their wealth, but the question is, what exactly the fraud was that led to a sudden downfall? Even though this company was audited by one of the big 4 audit firms, why did auditors fail to detect the fraud early? And can we, the small investors, be able to protect ourselves from fraud and sudden evaporation of wealth? Well, according to CBI, fraud began very early in 1999. Management of the company was very aggressive and committed to investors to grow its business at very high pace. To achieve this growth, management started manipulating financial accounts. Manipulation began as a marginal gap between the company's actual operating profit and numbers reported in the books. But slowly, management started creating false clients and invoices to falsify the financial performance. And over the period, it grew to such a large extent that for the September 2008 quarter, the reported profit was 649 crores, whereas the actual profit was just under 61 crores. Not only this, the management also took a step further. Whatever the cash profit the company was earning, chairman siphoned this cash out to buy land and properties in his personal name. And the funny part is that even though the cash was going out of the company's book, the reported cash balance was increasing. This means management was also inflating the cash and bank balance. As of end of September 2008, the reported cash and bank balance was 5,361 crores, whereas the actual amount was just under 321 crores. So management was not only inflating profits, but also cash and bank balance. Then, at one point, when it became difficult to manage the widening gap between the reported and actual numbers, the chairman sought to merge the other 2 family-owned entities. His plan was to use the fictitious cash to pay for these entities, and since the cash was to be paid to the chairman himself and his family, it didn't matter whether the actual cash was paid. This, if happened, could have removed the fictitious cash from the books and could have given the company some air to breathe. But investors criticized this deal because it was clear case of conflict of interest. Investors questioned since Satyam was IT service company, why is it acquiring unrelated high-risk real estate assets? This intense backlash from the investors cancelled the deal, which in turn caused panic selling, with Satyam shares falling 55% in New York Stock Exchange. This failed acquisition and subsequent scrutiny forced chairman to admit that he had inflated company's financial results. And this is how the fraud came into the light that led to the collapse of Satyam's shares. Now, as we know, the role of external auditor is to assess the corporate governance and ensure financial integrity. In case of Satyam, even though the external auditor was PwC, a Big Four audit firm, they still failed to detect fraud. Still, the shocking part is, how can an auditor incorrectly report the cash balance of a company? Well, the clear answer is gross negligence in auditing and relying heavily on forged bank documents provided by the management. This means that the auditors did not independently verify the documents. This case study forces us to question that if independent auditors are not performing their roles properly, how investors can protect themselves from frauds and ultimately the permanent loss of capital. But when we think about it, this also gives us a lesson that investors need to do their own due diligence instead of relying only on auditors. Since all the analysis that investors do to value the business is based on the accuracy of financial statements, evaluating the quality of accounting done by the management should be the central priority of the investors. So here is the 3-point checklist that investors must go through to identify the fraudulent companies. Firstly, look at the promoter's interest outside the entity. If promoter is the director of many unlisted companies, there is a chance that promoter can siphon off the money from the listed company to his unlisted companies. Also, if you see high promoters pledging the shares and continuous reduction in promoters' shareholding, there is a high chance that something fishy is going on in the company. Secondly, look at the board of directors and audit committee. If board of directors mainly consist of the friends and family of the promoter, it allows the promoter to easily manipulate the books. Also, if there is a frequent resignation from independent directors and auditors, this means something is wrong with the company. And lastly, look at the off-balance sheet liabilities. Companies often hide obligations such as operating leases and special purpose entities to increase operating profit. So if you see extremely complicated or frequent changes in disclosures, be cautious. And finally, to end this video, remember, markets will always have noise, narratives and occasional frauds. But your process can be clean, consistent and in your control. Every annual report you study makes you sharper and more independent. So I want you to leave today with one belief. Your due diligence can only protect your capital. And that was it for today's video, and I hope this video was valuable to you. If you find something valuable in this video, please like this video and subscribe to this channel. Thank you so much for watching. I will see you in the next video.